Hello, OptionStrat traders. Steve Ganz here, sharing another trade idea slash concept with you. Now, I'm going to stress again, this should be a paper trade. This is for learning purposes. I did upload this trade earlier, or this video earlier, and it seemed to be locked for some reason. So some of the things I want to share, and I want to make sure that they're opening up properly, are these two windows here. So it looks like they are this time. So let's get into this. Let's talk about this trade. So what I'm looking at specifically is I'm looking at a trade in NVDA. Now, NVDA announces earnings after the close of the market tonight. So this is a time when the front period options, the options closest to expiration, are going to have a very high volatility to them. And then further out options are going to have a lower volatility. So a calendar trade is a little bit tricky here. So let me just kind of walk you through what I'm trying to do. So under normal circumstances, I mean, NVIDIA has doubled in price here in the last 6 months. It's gone from $140 up to $317. Huge, huge move. This earnings announcement will likely cause some movement, maybe some significant movement under normal circumstances. I might expect this to maybe pop up to 335, 340, maybe drop it down to the 280 range, something like that. So I'm trying to cover a pretty wide range here with whatever my trade proposal is. So let's call it, 280 to 340. So this calendar kind of seems to do that. If this tent shows that we should be able to get all the way out here to 275 before we have some problem, and all the way up to 335 before we have some problems. Now, I will tell you that is not really true. That's how it models right now based on volatility being where it is. But tomorrow morning, after the earnings are announced, volatility is going to drop considerably, and you're going to see this tent shrink down a massive amount. So our window is not really as wide as it might appear here. The window on an iron condor, for example, or a butterfly is fixed because all of the options expire in the same expiration period. In the case of a calendar, we're dealing with two different expirations. So we have one option, we're going to sell a put. This put is a 300 put, and it expires this Friday. And then we're going to buy a put, the exact same strike, that expires next Friday. So what does this do for us? How is it this whole thing works? Well, let's take a look here. So if we sell our put that expires this Friday, the thing I want you to notice here is that the IV, the volatility on this, is very high. It's showing 116% right now. So it only makes sense that that front period volatility is high because people don't know what's going to happen with earnings tonight. So there's some fear in the market. And if somebody owns a long stock in NVIDIA, for example, they might want to be buying insurance on this just in case they say something that tanks the stock. That's what causes volatility to go up, is a lot of people that might be buying puts because they have a fear of this. So we can sell those puts for about $10.90. So now let's take a look 1 week out. Let's go to look at the one we're going to buy long. So remember, 116 and call it $11. So if we go 1 week out, our IV is less than half. Our IV is at about 66%, and we're going to have to buy that long put for $12.65. So the difference here between the $11 that we're going to sell this Friday's expiration for and the $12.65 that we're going to buy next Friday's for, that difference, and of course that difference is moving here with the market, is going to be approximately our net debit, which is going to be approximately our maximum loss in this trade if it goes hugely against us one direction or the other. So anyhow, to get into this trade, I am going to, again, sell this Friday's expiration, which is high volatility. I'm going to sell it for whatever, $10.92, $11, somewhere in there. And then I'm going to buy the exact same strike a week away for $12.60 or whatever the price is at the time I execute this trade. So what am I looking to have happen here? Well, Ideally, I want NVDA to open tomorrow morning as close as possible to where it closed tonight. So somewhere in a general window of, maybe 290 up to 310, 315, somewhere in there. If it opens in that window somewhere, let's just take a look here. So this is the trade as we enter it today. This is what our T0 line is going to look like. Well, then tomorrow, as decay happens, and it will happen fast after the earnings announcement takes place, my goal is going to be obviously to have NVIDIA open in this general window, this decay to happen quickly, which it will. No matter where NVIDIA opens, a decay will happen quickly. And then I want to go ahead and close this trade out, for maybe a 50% profit, somewhere along those lines. So again, if I sell this thing, if I buy this thing for $170 for the calendar, maybe tomorrow morning I'd like to sell this for $250, $270, somewhere in that general area. So that's going to be kind of my goal or my objective. To be clear, my objective is not, while this trade technically has the, call it $200 in risk, and it has a reward of $886 if I peg the $300 strike at expiration on Friday. I am in no way, shape, or form shooting for that. This is simply a measurement of the risk to reward ratio. It kind of helps me decide, is there a ratio here that's good, that I like? So anyhow, that's kind of what I'm looking at on this trade. Now, I need to be clear on something else here. Calendars are very different in that we have these two different strikes on, but they're going to expire at different times. So this one is going to expire this Friday. Right now, this trade, as it sits, with both of these strikes, our short strike and our long strike, this thing does have a risk around $200 maximum dollar loss. However, if we get to this Friday and this strike expires and we don't do anything with this long strike, we don't close it out, we just leave it set out there as well, our risk could be significantly more. So it's very, very important when you're dealing with these trades, with calendar trades, to make certain that unless you really know what you're doing, you don't ever want to leave one of these out there without the other. Now, you could adjust this in a lot of different ways. I'm not going to try to get into that right now. Just know that with a calendar, your risk here in this trade is only accurate while you have both sides of this trade on. If one side expires or you take one side off without taking off the other side, it's a different trade then. And you need to make sure that you recognize that and understand what your risk and reward might be then on that new trade that only has the single option associated with it. So what I want people to do is I'm going to go ahead, I'm going to save this trade. I'm going to share the link in the description below, and copy that link, pull it into your OptionStrat. And if you can, tomorrow morning at the open, I want you to have this screen open, and I want you to see right as that bell rings, or within 2-3 minutes of the bell ringing, look and see what happens to this tent. This tent is going to shrink down considerably. Now, if we're still in our little zone here, we could still have a nice profit in this trade. Again, recommending paper here. But more important than, profit or not profit at this point is understanding how a calendar works, how a calendar moves, and how this tent changes shape, where a butterfly tent won't change shape, an iron condor tent won't change shape, a calendar will. So that's really the takeaway that I want people to understand and take a look at in this trade. So go ahead, copy this, take a look at it tomorrow morning. And thanks a lot, everyone. This should be a good exercise.